Good afternoon. This is Sean Golden with Golding and Golding, here to discuss a very important topic, especially based on the globalization of the U.S. and the world economy, and that is, are visa holders subject to U.S. tax on their worldwide income? Is it just limited to their U.S. sourced income? Let's walk through it. So, it doesn't have to be visa holders, but commonly, visa holders who stay for a long amount of time in the U.S. may become subject to U.S. tax on their worldwide income. It could be any type of visa holder. You could be on an L1 transfer, H1B employment, EB5 investment. You could be here on a B1, B2 tourist visa, or an E2 or E3 from Australia. Any one of these types of visas, it doesn't really matter what the purpose is. They're essentially grouped together for tax purposes, noting there's some exceptions for like the first 5 years on an F1 or the J visa, usually for the first 2 years, depending if treaty applies. But the idea is, if you're in the United States, even if you're not a U.S. citizen or a lawful permanent resident, when you use what's called the substantial presence test, which is essentially a counting days test, and you're here for a certain amount of time, then you're subject to tax on your worldwide income, similar to a U.S. citizen or a lawful permanent resident. Essentially, what you do is you count days in the current year, which is 1 to 1. So if you're here for 50 days, you count 50 days. You go back a year and it's 3 to 1. Excuse my math because it's quick math, right? If you're here for 60 days, then 20 days count. And then you go back another year and then it's 6 to 1. So if you're here for 60 days, it counts for 10 days. You mix that all in a pot, you add it up. And if you exceed the amount of time, then you meet the substantial presence test and then you're taxed on your worldwide income. That means that you file a 1040 instead of a 1040 NR. Now, some people may qualify for an exception. There's closer connection exception. There's certain positions that are exempt, certain medical conditions. If you're in the U.S. for certain purposes like that, then it doesn't qualify. Typically, the first 5 years in F1, like we mentioned. But baseline perspective is, if you're on a visa, even if you're not, and you remain in the U.S. for too many days, then you are now subject to U.S. tax on your worldwide income. Being taxed on your worldwide income can be a big deal because, especially if the majority of the income is foreign sourced, and let's say it's a low tax jurisdiction or it's exempt. Maybe the personal income tax is exempt, you're in the UAE or something, and you're in the US on an assignment. Now, income that was not taxed can be taxed in the United States. And it involves not just earned income, but passive income as well. Maybe you're earning dividends, interest, royalties, capital gains in a foreign country. You may be taxed on that income if you're considered a U.S. person for tax purposes, even though in the foreign country it may be a very reduced tax rate or it may be exempt from tax in that country. If you already pay tax overseas, you may qualify for foreign tax credits. You file a Form 1116. It's not always a dollar for dollar credit, but for the most part, it should cover a majority of the taxes paid so that you're not paying double tax. If you overpay tax, you could typically carry the credit forward to use on foreign income in subsequent years. If it's 1 to 1, then great, then it cancels everything out. And if you're in a lower tax jurisdiction, then you may have some foreign tax credits to apply, but then you may still owe some U.S. tax on the difference. So just because you paid full tax in a foreign country doesn't mean you'll have sufficient tax credits when it comes to filing your U.S. return. Common question we receive is, can you avoid worldwide income taxation? So let's go through some of the strategies, right? It's a simpler strategy than other types of planning because it's just a counting days test often. So one, avoid substantial presence. Try to plan out the number of days you're going to be here. Obviously, life doesn't work that way, right? But you try to plan it out the best you can. Or there's certain easy exceptions. Like, let's say there's no need for you to be in the U.S. this year. Then if you're not here for at least 31 days, then you can't meet the substantial presence test, even if you were here for lots of days in the prior year. So something to keep in mind. Otherwise, a common, I know we mentioned earlier, is the closer connection exception. You file a Form 8840 and you claim an exemption. You could claim it based on the fact that you have basically a closer connection with a foreign country or multiple countries. It doesn't have to just be one country. It can be multiple countries. Now, there are some pitfalls to be aware of, tax traps, and one common one is most of the time if you've already applied for a green card, you don't qualify for the closer connection exception. Something to keep in mind. Other exceptions as well, Typically, if you're working in certain positions or you're here for certain medical reasons, certain days may not count. Another way that some taxpayers can avoid it is treaty elections. If the U.S. has entered into about 60 income tax treaties with foreign countries, and based on what the person's status is in the U.S. and the specific treaty, they may be able to use that to avoid tax on their worldwide income. So maybe they met the test, but the treaty says, someone who's here working on certain visas the first 2 years, they're not subject to U.S. tax on their worldwide income, only tax on their U.S. sourced income. And for some people, it doesn't really matter, depending on where their income is sourced, if they have foreign tax credits to apply, things of that nature. You may also qualify for the foreign earned income exclusion, but most of the time you're in the U.S. Sufficient to meet substantial presence means you probably won't meet either of the foreign earned income exclusion tests. If you didn't realize that you were taxed on your worldwide income and you didn't do the reporting that's required as well, because as a U.S. person, you're required to report forms like the FBAR, the Form 8938, 3520, etc. The IRS has developed various amnesty programs to assist you with getting into compliance. If you're willful, there's the Voluntary Disclosure Program, VDP. If you're non-willful, there's lots of other procedures available to you. There's the streamlined filing compliance procedures. There are the delinquency procedures, and even possibly a reasonable cause submission. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.